It's time for the Trading Stocks Made Easy podcast. Each week, Trading Stocks Made Easy demystifies stock trading and investing so you can profit big. And now, here's the host of Trading Stocks Made Easy, the wealthy investor, Tyrone Jackson.
Oh my goodness, you and I are back together. This is Tyrone Jackson, the wealthy investor, for another episode of Trading Stocks Made Easy. Do you have any idea how much I like spending time with you? I hope you like spending time with me. Because what am I, Mr. Rogers today? I'm your neighbor. You're my neighbor, for those of you who remember that. No matter how I want to phrase it, I'm just happy that we have some time together here today. Today's show is just you and I spending some time because there are a couple of things I've realized as of late. A lot of people are interested in the stock market, but they don't know how to choose stocks, and they aren't familiar with the story of the stock. So I always say in the Wealthy Investor program, never buy the stock if you don't understand the story. The basic idea here is understanding how a company generates revenue or income to stay in business. When we understand the story of the stock, we can look at the revenue and we can choose whether that story is right for us as a long-term investor. So here's what I'm going to do. In the first part of this episode, I'm just going to give you a few tips and ideas on how to follow the story of a stock. And I'm even going to give you some specific stocks that I like right now in this market to kind of help you along the way. In the second part of the show, I'm going to talk to you about strategies. So a lot of people say, well, I know how to make money when the stocks go up, but I have no idea how to make money when the stocks go down. And I want to share with you some simple formulas that I use in my trading accounts that I pass on to my students and some systems that I use to make money when stocks go down. Now, I always say you're not a genius when the market as a whole is rising, but you really do have some skills if you know how to make thousands of dollars when the market is falling. So right after you take a listen to this, I'll be back with some stocks that I really like, and I'll be explaining the stories to you. Back in a moment.
You're listening to the Trading Stocks Made Easy podcast. Want to learn more about how to trade and invest in the stock market? Visit thewealthyinvestor.net/products. That's thewealthyinvestor.net/products and order the Wealthy Investor's Guide to Stock Market Success audio series. This easy-to-follow 5-CD audio series and manual will teach you the basics of how to buy and sell stocks, how to collect quarterly dividends for life, plus hidden income generating strategies like covered call writing and volatility trading. Start creating financial freedom right now. Get the financial education you need to get ahead. Visit thewealthyinvestor.net/products.
Okay, right before the break, I talked to you about some stocks that I wanted to share with you and some stories that I actually like and some methodologies for choosing stocks. A lot of people say to me, particularly at my live events, how is it that you get so good at choosing stocks that go higher and tend to double in value consistently? Well, I'm going to let you in on a little secret. There are a bunch of tools that I use to choose stocks that have the greatest probability of going higher. Now, I don't have time to share all of them with you today, but I'm going to choose and share with you just a few that I think will really, really help put you in the fast lane if you find that you'd like to be really good as a stock market investor. Now, I'm going to talk to you about 3 stocks that I really like right now in this market. Every stock in the stock market, as you know, has its own ticker symbol. And I want you to look up these tickers and I want you to research these companies. These are not recommendations. I'm not telling you that you have to go out and buy them. I'm simply sharing with you 3 stories that I like for the long term of stocks that I think have the greatest probability of going higher. Again, not recommendations. They're just stories that I like. If you choose to buy them on your own, then join me. Or if you have your favorites, you can stay in your lane. Let's get right to it. The first one is ticker symbol DPZ. And you know that company as Domino's Pizza. Now, let me tell you a story behind this stock. In the last 5 years, these shares have gone from $49 a share to a high of $212 a share. Well, imagine if you started purchasing these shares when they were $50 a share. Did the stock double? In other words, has it gone from 50 to 100? The answer is yes. Has it gone from 50 to 150? Yes. Has it gone from 50 to $200 a share? Yes. Well, what are some of the criteria and tools that I like to use to choose a stock with the greatest probability of going higher? The first is something that we call top line revenue. Now, that's kind of like a company's gross income. What did they earn for the year? To simplify, I like to buy companies that have 3 years of top-line revenue growth, preferably 3 consecutive years of top-line revenue growth, meaning that that company's gross income keeps growing year over year over year. So let's take a look at the top-line revenue here. In 2014, Domino's Pizza grossed $1.9 billion. In 2015, Domino's Pizza grossed $2.2 billion. And at the end of 2016, the company grossed $2.4 billion. So 1.9, 2.2, 2.4. We have 3 years of consecutive top-line revenue growth. When I see that pattern, there's a high likelihood that the stock is going higher. Right? So there's a methodology at play. It also has a float of about 44 million shares. Now, when I see top line revenue growth and a small float, I know if those revenues keep coming out higher, the stock is actually going to rise. So that's the fundamental part of the story. What is the revenue part of the story? Well, we know that they make money selling pizza, right? But that's not really how this company's experienced tremendous growth. It has to do with how they sell pizza. You see, these days, instead of calling a pizza shop and saying, this is what I want, you can order your pizza online. You can even have your credit card on file with Domino's Pizza so that when you order your pizza, it goes straight to charging your credit card and then delivered to you in 40 minutes or less. Why is this trend really important? Because this company has turned it into a billion-dollar trend, because they tend to link their catering services with special events like the Super Bowl, the World Series, the U.S. Open, anything where people are having large amounts of people over to their home. You're going to start to see more ads on your television screen for Domino's Pizza because they want you to use them not for one pizza, but for catering. So in other words, for $150, you can now have 8 pizzas, sodas, drinks, cheesy breadsticks, and Coca-Cola, Pepsi-Cola, and Sprite delivered to your home within 40 minutes. Because of the ease and convenience of this service, Domino's now earns billions and billions and billions of dollars. They also keep their menu item very simple. So you think about the people who are actually preparing the food at Domino's Pizza, they're really only preparing about 14 different things, right? And the game becomes how quickly can they get them out the door and charge to your credit card. Do you get it? So I'm not making up the story. It's a marketing story mixed with an app, which is technology, mixed with 14 items on a menu, and people are following the system, and they're ordering these pizzas to the tune of billions and billions of dollars. So do I think that this is a stock that's going to go higher? Absolutely. Now, if you missed the rise in the stock, that's fine. Your job, along with my job, is to get our shares long before they reach that $212 per share. Let's move on to the next stock. Now, in the Wealthy Investor Program, very often I cover stocks that don't get a lot of attention in the media, so I may give you a name of a stock, and you may say, Tyrone, I have no idea what that is. And this next one is an incredible choice and an incredible story. The ticker symbol is AMT, and the company's name is American Tower Corporation. So let's talk about the stock price first. Over the last 5 years, the stock price has gone from $65 to $131. Obviously, your goal is to be in when the stock is a little bit cheaper, and you simply ride it up as long as the revenues are there. In 2014, the top line revenue was $4.1 billion. In 2015, a year later, the top-line revenue was $4.7 billion. And at the end of 2016, the top-line revenue on an annual basis was $5.7 billion. So I see that revenue growth, and it has a float that I really like, which is another one about 424 million shares in the float. And as you know, of the 424 million shares in the float, some of it is on lockdown by institutions, which is even better, because that actually shrinks the float a little bit and puts pressure on the stock price to actually rise. So that's why I love this company from a fundamental point of view. But what is the story? How do they actually make that revenue? How do they earn that revenue? Well, the name of the company is called American Tower. Now, you know when you use a cell phone, that cell signal bounces from tower to tower to tower. Well, big companies like AT&T and Verizon used to build these cell towers, and in certain areas you got good reception, in certain areas you did not. But what they discovered was the cost of building and maintaining these towers grew higher and higher. So what they'll do is they'll actually lease space on a tower that is owned by the American Tower Corporation. Now, what does that mean? It means big carriers like AT&T and Verizon, for example, just lease space on a tower, and if something happens where the signal is blocked from the tower, it's not their problem. Why? They're just a tenant leasing the space, and they can call American Tower and say, why is our signal weak in this area? And American Tower can say, we're working on it. In other words, they're outsourcing the signal from tower to tower. Now, American Tower is also buying up cell towers and building them all over Europe, all over the world. What does that mean for you? Your cell phone coverage is going to be better. Now, if American Tower is building and maintaining the towers, then what are they actually doing with their clients? AT&T, Verizon, T-Mobile, they are taking in lease payments, almost like a rent payment that you would have like in an apartment building. The cost of these towers and the lease agreements go up over time as towers are added. Do you get it? So that's why the stock has done so well over the last 5 years, again, going from $65 to $131 because of the story. And we all want better cell phone coverage, don't we? Right. Well, sometimes we have to know the story of a stock behind the scenes. Now, AMT, American Tower Corporation, you don't hear a lot about it in the media, but yet still the stock has doubled in the last 5 years. Let's talk about this idea of doubling your money consistently over a 5-year period. It doesn't happen on every stock that I choose, but it happens with enough frequency so that me and my students reap the benefits from it. Okay? So this whole idea, if you were investing money, it means that you're able to take $5,000. You choose the right companies, it turns into $10,000. $50,000 turns into $100,000. $100,000 turns into $200,000. And $200,000 invested in a stock turns into $400,000. And all we did was participate as shareholders. This is very, very powerful, change your life information when you learn how to be a strong, consistent investor in the stock market. You understand why there's so much wealth that comes from the stock market. What I do during this podcast is take topics that are fairly complex and break it down so that you can begin to understand how money and wealth is made in the U.S. stock market. And most importantly, how you can get involved and start participating in ownership of some of the companies that I like and some of the trends that are going on in our world that are constantly changing. Now, here's a story and a name that you'll probably be familiar with. The company's called Amazon.com. You ever hear of that? And the ticker symbol, of course, is AMZN. Now, this is an amazing story because, as you know, Amazon started out selling books online, and now they are ubiquitous and they are selling everything. And you remember not too long ago, they announced that they're purchasing Whole Foods, so that puts them in the grocery business. Now, when a giant like Amazon gets in the grocery business, they can drive costs down for all of us. They want billions and billions of people to pay for the service at a lower price so they can earn enormous profits. Well, in the last 5 years, Amazon.com stock has gone from $300 a share to upwards of $950 a share. Now, let me share with you one of the things I've been saying a lot at my live events. The reason that most retail investors, people like you and I, don't experience large amounts of wealth is because they tend not to like stocks over $100. The dominant thought is, I don't want to spend over $100 for one share of stock because I can buy a bunch of shares on a stock that's under $100. And that's just the wrong way to think about the stock market. You see, I'd rather own something that's a little bit more expensive, that has the highest probability of going higher than something cheap that's going nowhere. A lot of people really don't understand that in the stock market, and that's why you need a financial education. In real estate, the idea is to buy low and sell high. In the stock market, the idea is to buy high and sell what? Higher. So I don't mind owning a stock at $300 a share if it has a tendency to go to $950 within a 5-year period. Amazon's top line revenue in 2014, $88 billion. 2015, $107 billion. That's quite an increase. In 2016, $135 billion. What do we have? Yet again, a pattern we can rely on. 3 years of top-line revenue growth. Now, for those of you who are more technicians, Amazon also has a very, very small float, which really surprised me, which is another reason why the stock does really, really well. Of course, 50% of the float is held by institutions, so therefore, we as investors are the recipient of the stock price going higher because that float, the shares outstanding for the public, gets smaller and smaller and smaller. So these are some of the tricks that I really like to use. And again, these are choosing stocks for investing purposes. So if the stock goes from 300 to 600, that is a 100% return. I've doubled my money. That means what? 10,000 turned into 20,000. $50,000 just holding the stock within 5 years turned into 100,000, 100,000 turned into 200, and $200,000 turned into $400,000. Now, the name of this podcast is Trading Stocks Made Easy. I'm showing you right now that there are patterns in the stock market. As long as you have that financial education that you can take advantage of, things like float size, top line annual revenue, and you are stacking the deck in your favor. Now, these are secrets that most Wall Street insiders would not dare tell you about. Why? Well, these are tools that make institutions billions and billions and billions of dollars. But here on the Trading Stocks Made Easy podcast, I believe some of these patterns need to be exposed so that if you want to participate in the stock market, instead of giving your money to, let's say, a mutual fund manager or resenting rich people who make money, why don't we just pull the curtain back and I can show you exactly how it's done. Now, just for maximum clarity, I'm not telling you that every stock that I choose is a winner, but if you lay down a certain criteria, right, and you understand the fundamentals, the revenue growth, and why, the next thing is to understand the Amazon.com story. So Amazon expand from books into almost everything retail. So now they're selling shoes, now they're selling airplane supplies, now they're selling oven supplies, beauty items, tools that you could use in your home, and a vast array of retail items. Now here's the key. Amazon.com doesn't necessarily make or manufacture these items. They partner with people who open up Amazon stores to sell their items on Amazon. Amazon can either have those products drop shipped to you in a box and take a fee from that small-time retailer, or they can partner with a bigger retailer and do the same thing. So once they got out of the book business and they expanded into the retail environment, we saw a lot of that top-line revenue explode. And now we know they're going from retail items for your home into shopping. So they're huge. What's another way in which Amazon actually grew its revenue? Through a subscription-based program called Amazon Prime. When you start a subscription-based program like Amazon Prime, you have a guaranteed amount of annual revenue coming to you constantly. Costco does the same thing. And so I like companies that have this guaranteed revenue coming in because they're billing your credit card just to be a member, which means what? Huge growth on the top line before your customer base even buys anything. So getting a financial education about how the stock market works opens up a lot of possibilities that you should be really excited about. Now, on the other side of this break, I'm going to come back to you and share a few more tips about trading stocks, since we've just discussed how to invest in a few criteria I actually use that help me and my students do really well. But I'll be back with you right after you take a listen to this.
You're listening to the Trading Stocks Made Easy podcast. Want to learn more about how to trade and invest in the stock market? Visit thewealthyinvestor.net/products. That's thewealthyinvestor.net/products and order the Wealthy Investor's Guide to Stock Market Success audio series. This easy-to-follow 5-CD audio series and manual will teach you the basics of how to buy and sell stocks, how to collect quarterly dividends for life, plus hidden income-generating strategies like covered call writing and volatility trading. Start creating financial freedom right now. Get the financial education you need to get ahead. Visit thewealthyinvestor.net/products.
And welcome back. Now, in today's episode, we've been talking about, up to this point, choosing investments. You know I like to choose stocks that have small floats with top-line revenue that is constantly growing year over year. We refer to that as 3 years of top-line revenue growth. Trading is another endeavor. Now, I know there are a lot of people out there who fancy themselves really great stock market traders and investors, but what I find is really interesting is they can't tell you how to make money when stocks go down. You know, markets don't always rise. We like for our stocks to rise. We prefer for our stocks to rise. But what do we do when there's something called a pullback? Now, if you're not really familiar with the stock market, I find there's a lot of people like to use the word crash. We haven't had a major crash in the stock market in a long, long time. What we have had is a series of pullbacks, where the market as a whole, the Dow or the S&P, kind of pull back a little bit. And the reasons that stocks pull back vary. Some of it has to do with geopolitical, right? Something going on in the world that causes the big Wall Street institutions to sell some of their stocks, take a profit, and wait for that crisis to end. And some pullbacks are caused by sectors. Now, what does that mean? Well, one of the sectors in the stock market is the technology sector, where we have almost all these .coms, right? And if all of a sudden, during an earnings period, one of the major leaders in a sector earns a little bit less than Wall Street analysts expected, that can cause the entire sector to pull back. Why? Because if one of the big dogs made a little bit less money this year, then you know some of the smaller players might feel it as well. So we can experience a sector pullback or a market pullback. Now, when the entire market pulls back, we refer to that as a broad-based pullback. And when a sector pulls back, right, stocks in that group actually go down in the short term, that is a non-broad-based or sector pullback. Okay, so I love seeing a broad-based pullback because there's certain strategies that I could use while the market is going down temporarily. So I'm going to give you some formulas I want you to remember. Number one, when stocks are rising, and in Wall Street terms, we refer to stocks rising as bullish. On Wall Street, bulls represent aggression. Bears represent retreat. So the market is either bullish or it's bearish. Now, I don't want to confuse you too much here, but you can be in certain markets that are long-term bullish and you can be short-term bearish in that market. There's a trade for that, right? Okay, but generally, whenever I'm trading or I'm investing in a stock, I am bullish, as is most people who put the money in the stock market. If you're actually buying a stock, most of the time you're not going to go home, say a silent prayer and say, God, I really hope that this stock tanks and I lose all my money, right? Because you have to be hopeful about the future and future earnings. In other words, you have to be bullish on the stock to be successful. So when stocks are rising or we're in a bull market, in the Wealthy Investor Program, we sell covered calls. What kind of covered calls? Out of the money covered calls, preferably. Now, on this show, you've met a lot of my students, and we all talk about how much money we actually earn generating covered calls. We do it both in two types of accounts. One, our cash account, and then also in our retirement account. We can also do it in an account that we set up for our kids in college, et cetera, because covered calls, which I believe is the single best trade for the retail investor in the stock market, covered calls brings in guaranteed income every single month. As long as you can own 100 shares of a particular stock, you're going to make guaranteed money selling an option to someone you don't know to buy that stock away from you. I won't go into it too much because on every episode you hear one of my students who are real people just like you saying, I love covered calls. Okay, so when the market is bullish and stocks are going up, we are covered call writers, preferably out of the money covered calls. We want that guaranteed income from the stock market. When stocks are bullish and the prices are rapidly changing, we refer to that as volatility. So when volatility is high, we become volatility traders, where we can buy a stock at a particular price and the software in our account will sell it for us. A lot of people think this is day trading, but it's not. Because if I buy a stock at, let's say, $60.50, inside my online trading account, I can tell the software at what price I'd like to sell that stock. Program it in. I'm out living my life. When the stock is sold, I get an email. Now, how easy is that? So when markets are bullish, we are writing out of the money cover calls and volatility trading. When markets or a sector is bearish, when they're pulling back in the short term, We are selling in the money covered calls, meaning I'm going to buy a stock and I'm willing to sell it for less than what I paid for it, hoping the stock will drop and I profit from that decline in the stock. Now, that's where you really need a financial education to learn how to sell in the money calls. It's a real skill, but I promise you it is not difficult at all. Again, it just comes back to that, getting that financial education that will move you ahead under all market circumstances. So when there's a pullback in a sector, or there's a pullback in the market, I lean on the in the money call so that I can profit from the stock in the short term going down. When you get to a certain level of trading, you'll learn how to use spreads, which is buying an option and selling an option against another option. I teach my students how to do it for a 100% return. In other words, how do you take $100 and turn it into $200? How do you take $1,000 and turn it into $2,000 when stocks are falling? And the faster that fall, the faster your money actually multiplies. We use something called a bear call spread. So in other words, just so you know, when stocks are declining, we're selling in the money calls against our shares and setting up bear call spreads to do what? To double our money. Okay, to double our trading investment, not necessarily double our whole account, but double our trading investment. We want to take advantage of that pullback in the stock market. And finally, here's what I really want you to take away from this particular episode. You should never be afraid of losing your money in the stock market if you have the right financial education, because a stock can only do one of three things. It can go up, go down, or stay the same. Go up, go down, or stay the same. Remember, when stocks are going up, the market is bullish. When stocks are going down, the market is bearish. And when the market is staying the same, we refer to that as neutral. So all you have to do is to learn how to trade and invest in stocks under three conditions: bull, bear, and neutral. And since those variables are only three things, you need to get a financial education and gain the skills to be successful under only three conditions. Well, if I can do it, I know that you can do it. So here's what I want you to know. A financial education for you right now is only a mouse click away. For some of you, that means going to thewealthyinvestor.net and downloading the free ebook that talks about covered calls. For others of you, you're ready to go to the next level and start trading with me online and getting that financial education at where? witradeschool.com. That's witradeschool.com. Now, you see some of the things that I've just discussed with you? Guess what? They're all online at witradeschool.com in a video format. So if you want to learn how to sell in and out of the money covered calls, all you have to do is become a member of WI Trade School. You can watch that strategy over and over and over. And best of all, each and every week, you get to send in your questions to me and I answer them in what? A video format. I do want to take one moment here for all of you who are Trade School members. I knew that I was on to something big when we started WI Trade School, but the emails that I get from those of you out there who've, made a lot of money in the stock market and do so every single month, I wanted to thank you for that, because I set out to spread the love for the stock market through the Wealthy Investor Program, not only in the United States, but throughout the world, because I really believe in helping people get a financial education so that if something happens to you and your family, you could live off your investments, your stock market earnings. I realize I don't say thank you enough to those people who sent in all these wonderful emails and you share your stories with me. I read them, I get them, and I thank you. Right now, you have to choose the action that's right for you. Join me at thewealthyinvestor.net, or if you're ready to go to the next level sooner and begin studying these strategies, start your membership right now at witradeschool.com. Okay, I hope you got something really positive out of today's show and you understand the benefits of getting a financial education and creating wealth and residual income for yourself in the stock market. Until next time, this is Tyrone Jackson, the Wealthy Investor, saying thank you for joining me. Keep an open mind and happy trading.
You've been listening to the Trading Stocks Made Easy podcast. Be sure to rate and review our show on iTunes. While you're on iTunes, be sure to click the subscribe button and you'll automatically receive our next episode.